You can close the biggest deals of your life, see record-breaking profits on your screen, and still go bankrupt by Friday because you can't make payroll.
Yeah, that is the ultimate business nightmare, honestly.
Right, being wildly profitable on paper, but entirely, completely out of cash.
It's an invisible trap.
It really is. It destroys ambitious startups and, it catches out seasoned executives every single day.
Oh, absolutely. They never see it coming.
But there is actually a mathematical way to see it coming months in advance.
It really is the silent killer of companies. I mean, the spreadsheets look phenomenal. The board is happy. Right up until the exact moment the bank account hits zero and the doors get padlocked.
Welcome to our global audience joining us for this deep dive. Today, we are covering cash budgets.
A super critical topic.
We will break it into 3 parts, look at a real-world example, and finish with 3 exam tips you can use immediately.
Let's jump right in. A cash budget is basically a plan produced to ensure there is enough cash within the business to achieve the operational levels set by your functional budgets.
Okay, let's unpack this because definitions can sometimes gloss over the daily reality. Think of it like a road trip.
Okay, I like that.
Your functional budget, your sales and your profits, that's your map showing you the destination.
Right.
The cash budget is checking if you actually have enough fuel in the tank to get there.
That is a great way to look at it. It's the survival guide.
Exactly. And here's a surprising fact from our sources today. A company can boast a massive 40% gross profit margin, which is incredibly healthy, yet still suffer a severe cash deficit that threatens its survival.
Yeah, and that feels completely counterintuitive to most people.
Right. If I'm keeping 40 cents on every dollar I sell, I should be swimming in money.
You really would think so.
Yeah.
But the profit margin completely masks the reality on the ground. Ultimately, the cash budget is the tool that tracks the vital delay between making a sale and actually receiving the money.
So why are examiners so obsessed with this topic? I mean, beyond the exam, why does someone running a department need to care?
Well, out in the real world, liquidity issues are the #1 reason new companies fail.
Wow. Number 1.
Number 1, if you have to pay for labor, materials, and overheads before customer cash arrives, you need to know exactly how to finance that gap.
Right. You can't pay your staff with an invoice.
Exactly. There are 2 reasons examiners love this. Here's the first. It tests a student's ability to separate accrual accounting, so sales revenues, from actual cash flow timing.
Got it.
And the second reason is it tests the ability to spot non-cash traps hidden inside standard accounting figures.
Basically, examiners love watching students try to pay real suppliers with imaginary, on-paper money.
That is a harsh way to put it, but yeah, that's exactly it.
Okay, there are 3 parts to this. Let's take them one at a time.
It sounds good. Let's start with part 1, cash inflows. The absolute golden rule here is that sales revenue does not equal cash inflow.
Because customers rarely pay immediately.
Right. When you sell something to a business, they negotiate payment terms. Like maybe 10% pay immediately, 60% pay a month later, and 40% take 2 whole months to pay.
And then you have to factor in the people who just never pay.
Oh, exactly. Irrecoverable debts. Say 2% of your credit customers go out of business or dispute the invoice. You have to remove them completely.
Simply put, making a sale is just step 1. Mapping exactly when that cash hits your bank account is what actually matters.
Which naturally leads us to part 2, cash outflows. Expenses drain your cash at entirely different rates than your revenues fill it up.
Usually much faster, right? Because suppliers want their money yesterday.
Always. Especially for new companies with no track record. Suppliers often demand cash on delivery.
Yeah, that makes sense.
Meanwhile, your labor might be paid weekly, but usually 1 week in arrears.
Wait, let me ask you about something in the material. Why does the material purchase budget look completely different from the material usage budget?
Oh, that is a massive trap. To physically use materials in production in, say, January, you might have to buy and pay for 50% of them a whole month before you even make the product.
Oh, wow. So the cash leaves your bank account in December for a product you make in January, and you might not get paid for until April.
That is the brutal timeline of business.
That's rough.
It is. But outflows are only half the trap. The real danger lies in what doesn't flow out.
Okay, which brings us to part 3, adjustments for non-cash items.
Right. And the classic offender here is depreciation.
Ah, depreciation. It's always hiding somewhere.
Always. It's often bundled right into your overhead figures. You might see $50,000 in overheads, but $10,000 of that is actually just a depreciation charge.
But a book adjustment in the accounts isn't a cash flow you pay out. I'm not like writing a check to my machine every month.
Exactly. The cash left the building years ago when you bought the machine.
So to bring that together, a flawless cash budget strips out the fiction of profit, maps the exact timing of every penny entering and leaving the building, and ignores non-cash bookkeeping tricks.
Beautifully summarized.
Let's look at a globally relatable business scenario from our sources to see this in action. Let's call them the Metal Box Company.
All right, the Metal Box Company.
So they manufacture industrial containers. Initially, the metrics look absolutely fantastic. Sales are booming.
We're talking $300,000 in January, $400,000 in February, and $550,000 in March.
And they have a really great 40% gross profit margin. Plus, they start January with a comfortable $150,000 cash in the bank.
So on paper, this is a runaway success.
Right. If you're an early career listener, maybe you're sitting on the sales team, you are popping champagne, you worked incredibly hard to get these orders.
But to secure those massive orders, you had to allow credit. Only 10% of those clients are paying up front.
Which means January only brings in $30,000 cash from $300,000 in sales.
Exactly. It's sobering. 60% pay a month later, and 38% after that 2% irrecoverable debt pay 2 months later.
And for the senior professionals listening, this is where the operational reality hits hard. Your supplier demands 100% cash upfront because you are new.
Right. Labor is running at 20% of sales value, materials at 25%, and cash overheads at 15%.
Let's look at the climax of this trap in February. Despite making $700,000 in combined sales across Jan and Feb.
In February, the actual cash inflows are just $202,000.
Okay, 200 grand, but what are the outflows doing?
They are punishing. You are paying for materials, labor in arrears, and overheads. Your outflows drastically exceed your inflows. You're actually at a deficit.
Wait, so that starting balance of $150,000 just completely evaporates?
Completely gone. In fact, they dropped $30,000 into the red by the end of February.
Bankrupt. With $700,000 in book sales.
Bankrupt.
Huh. So, why do this exercise? I mean, beyond just depressing ourselves.
Well, by seeing this exact $30,000 deficit months in advance, the directors can actually arrange financing early.
Oh, so they can go to the bank calmly in December.
Exactly. They show the bank the projected contracts for March, which, by the way, brings a massive cash surplus of $124,000 net flow.
Ah, so when that surplus hits in March, they can plan to buy that $60,000 non-current asset then, rather than during the February squeeze.
Right. And it helps calculate closing balances for receivables and payables for the master budget and monitors debt collection efficiency.
And that right there is exactly what the examiner is testing when they ask about cash budgets. They want to see if you can spot that hidden $30K cash crater in the middle of a booming business.
It's the ultimate diagnostic test.
But students get this wrong all the time. What is the single most common mistake?
Oh, hands down, it's deducting depreciation as a cash outflow.
And there is a real metacognitive reason for this. When your brain is rapidly scanning a dense list of numbers in an exam, it sees a $10,000 depreciation charge under overhead costs. It categorizes overhead as an expense and just assumes cash is physically leaving the bank.
The shortcut betrays you. The fix is a simple rule. Always ask, did cash actually leave the checking account?
Right. Try handing your supplier a depreciation schedule and asking them for change. Let me know how that works out for your liquidity.
Yeah, they're not going to accept that.
Okay, 3 exam tips you can use immediately. Here's number 1.
Remember the irrecoverable debt rule. If 2% of credit customers will never pay, remove them immediately. They will never become cash flow.
Tip 2, check the calendar for arrears. If labor is paid weekly in arrears, count the weeks.
This is a huge one.
Yeah. Some months, like March in our example, have 5 weeks, which drastically spikes your cash outflow.
And tip 3, always strip out depreciation from your overheads before calculating your cash outflow.
At the end of the day, remember this. A healthy profit margin does not guarantee a healthy cash flow. Sales are vanity, profit is sanity, but cash is reality.
That is the perfect way to summarize it.
For our younger listeners, mastering this turns you from someone who just records numbers into someone who can actually predict the future of a business.
And for the experienced professionals, the cash budget isn't just an exam hurdle. It is the ultimate diagnostic tool for protecting the business you've built.
So the next time you see record-breaking profits on your screen, don't just celebrate, check your cash budget to make sure you can actually pay your team on Friday.
Because remember, ensuring you have the cash to achieve your operational goals is the only way a business survives.
We want to genuinely thank our global audience for joining this deep dive. If you had an aha moment today, please follow the show on Spotify and leave us a review.
I really appreciate the support.
And before you go, mull over this one final thought. If a booming business with 40% margins can run out of cash this easily during good times, imagine what happens when a recession hits and those corporate clients unilaterally take 90 days to pay instead of 30. How resilient is your cash budget then? Keep digging deeper. Thank you for listening.